In this week's currency update, it's been a shocking start to the year for global financial markets and the worst start on record for global stock markets. The S&P 500 is down 10% from the December highs, and the Russell 2000 index, which includes many small cap stocks in the US, is down 10% so far this year and down 20% from the highs in June of last year. The wall of worry that global markets have been forced to climb feels like it's gotten bigger with every successive day so far this year. The North Korean nuclear test, events in Saudi, the Chinese stock market collapse and depreciation in the yuan, weak economic data, terror alerts in Europe, bombings in Turkey, and yesterday, Indonesia. Not surprisingly, commodity markets have been under aggressive pressure. Oil trading below $30, copper below 4,400, and iron ore below $40. Not surprisingly, commodity-linked currencies have been under pressure. The South African rand down 6.5% so far this year, and the Canadian dollar down 3.5%. Australian and New Zealand dollars somewhere between the two. It's hard to believe, on December 31st, the Australian dollar was trading above 73 cents. Last night in New York trading, we hit a low of 69.10. That's down 5.75% in just over 2 weeks. For all of the negative front page headlines, we've actually had some reasonably positive news from the global economy. Last Friday, US non-farm payrolls rose by well above expectations, 292,000, and the previous number was revised up significantly. On Wednesday, out of China, December trade data came in well above expectations. Iron ore imports for December were a fresh record high, and copper imports are up 14% over the last quarter versus a year ago. Finally, yesterday, we saw robust employment data here in Australia, with December jobs falling just 1,000 after the previous well above expectations rise of 71,000. We created 301,000 jobs in Australia in the last year. That's a rise of 2.6%. That's a robust outcome, and one that suggests that the Australian economy is successfully rebalancing from mining towards services. Now, our sense is that weak global economic data, soft commodity prices, and increased volatility in global financial markets is enough to knock the Australian dollar into a new lower 68 to 72 range. But the robust domestic jobs picture and solid equity-related demand for the Australian dollar through this quarter into next should limit weakness, at least in the near term, to 69 cents. Now, next week we get a number of events to watch out for. 3 central bank meetings, the BOJ and Bank of Canada on Wednesday, and ECB on Thursday. Economic data in China with Q4 GDP and in December industrial production on Tuesday. And finally, consumer sentiment here in Australia will all be closely watched. These are all factors we can talk about in next week's currency update.